Jill. We're talking numbers. Got
Right
a
up my alley today.
special guest with
Come
us
on.
today. We got Domenic Postorivo from Greentree Mortgage.
Hi, Dom. Welcome. Dom is a senior loan officer with Greentree Mortgage, and he's here to help our viewers, especially the first-time home buyers, take a look at what the mortgage process entails.
Dom, welcome to the show.
Thank you, Doug. Thank you, Jill. Thanks for having me today.
Our pleasure. It's exciting to have you here. Dom, a lot of people, it's pretty daunting. I mean, it's fun to search on Zillow and Trulia and all that stuff, but it's pretty daunting when they got to call the mortgage man up and they got to really find out, what they're qualified for. Is it a difficult process nowadays in 2016? For a lot of our viewers, they hear a lot of things like the underwriting standards are more difficult. It's tough to get a loan nowadays. Can you give us kind of a snapshot as to Snapchat? I'm on Snapchat, so a snapshot as to what's going on in 2016.
Hey, Doug, as long as you have a credit score of over 580, you have a little job work history, and also have a little bit of money in the bank, as little as 3.5% down for your down payment, you can get a loan.
That's great news for these home buyers.
That's great news is right, because a lot of times these people think I need 10%, 15% down. That's going to add up in a hurry. I don't know a lot of people that have that kind of money. So is it more difficult, though, if they're just trying to get pre-qualified, or is that pretty much an easy process as well?
Doug, it takes about 5 minutes. All they need to do is give me a call. We basically go over some work history. We go over their job history and also what kind of money they had to put down. And we can basically get them qualified inside of 5 minutes.
5 minutes. That's great. Now, what is the difference between the pre-qualifying for a mortgage and the actual mortgage application?
Okay, Joe, it's funny to ask. When you do a mortgage pre-qual, what that is a lot of that is verbal. So we'll go over the job history. We'll run their credit. We'll also see what kind of money they had to put down. See if they need a gift from any of their relatives at that point. Now, that's a pre-qual. Then they send me all their docs in. When they actually go under contract, when the house is open to buy, then they would actually sign a mortgage application. At that point, everything they've given me or have told me verbally gets basically processed. It gets verified through the mortgage application process.
Dom, what goes into determining, what a buyer can afford?
Okay, what happens is we have basically a formula we use. We use how much monthly income they have, and also what kind of debt they have. Debt does not mean cell phone bills. That means car payments, student loans, other mortgages, any revolving debt they may have, and credit cards. We take that number we divide that in, and we get a debt-to-income ratio. The debt-to-income ratio allows them and tells us what they can afford to buy, their affordability.
Okay, so it takes all of that into account. Now, is that just, I guess a lot of people go on Zillow and they're looking at the numbers. They're saying, I'm looking at a $200,000 house. If I plug that into a mortgage calculator, it comes up with a number. Is that the only variable that we're looking at for their payment? What else goes into the payment?
So it's funny you say that because they're not taking into effect the property taxes, homeowner insurance, if there's any HOAs or PUD fees, and also PMI. They're not taking into effect. So they really need to narrow down the home they want and the actual area they want to actually come up with a full number to get a real number of what their full mortgage payment's going to be.
Yeah, that can be pretty sobering, especially when they're considering buying a home that's $250, $300, $350, and you start adding in all the plus. Becomes very sobering quickly. Dom, what are some of the gotchas? What are some of the things that people do that they shouldn't be doing before getting a loan or at least getting pre-qualified?
Okay, the worst thing to do is close accounts. You don't want to close any open accounts, even if they've been dormant for years.
Bank accounts or credit card accounts? Dom,
at that point,
Dom, bank accounts or credit card accounts? Dom, did we lose him? Hey, Mr. Producer, did we lose Dom?
I'm here.
Oh, there you are.
Okay,
right.
we're back.
I couldn't hear what you said, though.
That's okay. I was saying bank accounts or credit card accounts?
Credit card accounts.
Okay.
So you don't want to do that. So that's the worst thing to do. And Jill and I, we talked about that briefly in episode 1.
Right.
It's ridiculous. It's completely insane that you're going to get dinged for closing your credit card account. You're doing the right thing. You're proving that you don't need this debt, and you're going to pay it off, but you're going to get dinged.
What's the logic behind that in lowering your credit score just because you shut down an account?
Well, the logic is this. The logic is they don't realize that you voluntarily shut the the account down.
Okay.
They think that the credit card company shut it down for a bad reason. So they initially ding you right off the bat.
Dom.
Now your score will come back between 60 and 90 days after that fact.
Well, wait, Dom, it's 2016. You mean to tell me that they can't determine whether or not this account was paid off voluntarily and not closed? There's no way. I mean, I almost feel like the credit card companies are in cahoots with the credit reporting agencies to keep you buried in debt. It makes no sense to me at all that they can't report that this was voluntarily closed and paid off.
No, I agree with you 1,000%. That's the way it's done. And nobody knows it's done that way.
Yeah.
Until
Well, that's a
it
great
makes
tip.
a big boo-boo and you can't get a mortgage.
Yeah, that's a great tip, Don. That's a great tip. Anything else?
Buying a car. You don't want to
Yeah.
buy a car when you're going through the mortgage process.
Do a lot of people do that?
A lot of people buy that. A lot
Really?
of people buy a new house, new car, new baby. That's what they want. Get them all in one shot.
Until reality
One of
sets
the
in.
worst things you could do. I mean, honestly, it really hits your debt-to-income ratio really hard.
Yeah.
So even if they've already put in the application, they've been approved, this car is going to show up. A lot of buyers think, though, oh, they already ran my credit. How's that
Yeah.
going to hurt me? I'll get to the settlement table and no harm, no foul.
Right, Jill, you sound 1,000% correct. But the day before closing, they do another soft pull. They run your credit again just to make sure that you haven't bought anything or
Okay.
done anything, out of the ordinary.
Wow, that's good to know.
It's my train. My train's coming in. Sorry, Dom. Just got a train running through the outside of the studio, but all fun stuff. Anything else that they should do? What should people really focus on doing? Jill and I again talked about this episode 1, where they were maintaining a good income to debt ratio, or the credit card, Jill. The percentage, 25%, 30% of the credit
A
card.
good thing to do is make sure you're employed. It sounds funny,
Yeah.
but some people tend to quit their job, as they're going through the mortgage process. They think that they already applied, but they get the mortgage commitment, they feel like they're good. You got to have a job.
Yeah.
Also, you want to make sure you pay all your bills on time.
Okay.
Credit card bills, car loans, student loans, very important. If you miss one payment or go 30 days late on just one, your score could drop 30 to 50 points, and it can make you not qualify, and also make you even pay a higher interest rate at that point.
Yeah.
Okay, so you may still qualify, but there's a penalty, and it becomes in the form of monetary payments. Okay.
Yeah. Jill, I was talking about the credit card. You should carry 25% on the
Right.
credit card.
How much of the usable balance?
Yeah, right.
What-
we see a lot of people. They'll go out and they'll get $1,000 credit line, and they'll be running $850 or $900 every month on that. Obviously, that's a big no-no, right?
Absolutely. You want to maintain between 35 and under 50%. That'll give you good credit, and it'll show that you have credit, you're making your bills on time, and you're making a payment. It keeps the trade line open. Once you get over 50%, it starts to really affect your trade line. Once you're over 75%, it really dings your score hard.
Okay.
Yeah. Well, Jill, I don't know. I mean, what else do you have? This is great.
Well, I guess a topic for another show, I know Dom has mentioned before,
Yeah.
are VA loans. Doesn't necessarily affect the first-time home buyer, but Dom, you had mentioned some staggering numbers before.
Some vets
about-
could be first-time home buyers.
They may be.
Right.
Can you be a home buyer under one of these programs and under a VA program? What are the differences there?
Yeah, Don. What if you have a vet come to you and he's a first-time buyer? Obviously, I think it was Look, what you said off camera about the vets being able to be into a home for like under $500 or some ridiculously low number. Obviously, that would be the program that they're going to go for.
Absolutely. They can actually get a loan with no money down, 100% financing. They can also negotiate the seller to pay 100% of closing costs, and they can get into a home for as little as an appraisal fee, which is $425.
Wow.
That seems like a no-brainer, but so many of our veterans aren't taking advantage of these programs out there. What was it you said?
85% are not taking advantage of it?
Absolutely. I think they feel it's too hard. All you really need is your honorable discharge and a DD-214. With that document, you can get a VA loan with 100% financing available.
I love it. Well, you know what, Dom? Sounds like that's something we got to do a seminar on and help these vets. They help us. We certainly owe them.
Absolutely.
And that would be a great opportunity to do a seminar to teach these vets that, it's being completely underutilized. I mean, this is an instrument out here that's there to help them. And do they just not know about it, or is it just that they think it's too hard?
too hard. I think they feel it's too hard. I think they feel that there's a lot of hoops to jump through, and there's really not. I mean, we actually can close them inside of 30 days here at Greentree Mortgage.
That's fantastic. That's fantastic. Like I said, Dom, we're going to have you back on the show. We'll talk more about vets, more about first-time buyers, more about everything mortgage-related. So there you have it, Jill. Episode 7 in the bag. It's a kind of a sterile one. I felt a little bit constrained. There's a lot of numbers. I get bored with the numbers. I get bored with the numbers, but that's, that's why Jill handles the corporate and contracts and compliance and all that good stuff. And
you're the
on
queen.
the other side, yes. So, well, you know what? We know you have a lot of places to spend time on the web. We're glad you spent a few minutes with us here today.
Take some time, drop in, follow us on Twitter, Facebook, Snapchat.
Doug and Jill, Snapchat. We're going to be Snapchatting this year. Big year, 2016. Snapchat. See a lot of inside, behind-the-scenes stuff we're going to be doing. Even Periscope. We're going to be doing some live stuff. So look out for that. Dom, we're going to put your information down below. You can reach out to Dom directly at Greentree Mortgage and or call Jill. Call us, and we'll answer any questions that we can answer for you. So again, Dom, thank you so much for being on the show. As Jill and I like to say, real estate is about much more than homes, buildings, and land.
It's about the communities and the people that live, work, and play in them.
Wait, let's try. I think it's about,
the people in the communities
where they live, work, and play. There it is. That's it. Until next time, I'm Doug.
And I'm Jill.
Thanks for watching.